different sort of funding to the bank because it's unsecure, which means it's technically targeted at organisations and maybe slightly earlier on in their journey? Back to you.
Yeah, you see, I go straight to the end and then I can gauge, like, what should I say? So I'm Amy, I'm the CFO at Sumerian. We're an impact first investor. We're probably a little bit smaller than most, but we've got a portfolio now of 23 investees. We're investing for impact, so we haven't got a set product or anything. We might do equity or debt, and I know that I'm introducing the jargon straight away, but I kind of view investment as being more than just about the money. It's about the relationship, and I thought it was really interesting, the panel that we had at the beginning of the day, where people were talking about, you know, being able to sit face to face with somebody and do something together, rather than it being a sort of imbalance in those relationships. So yeah, with Sumerian, with a team of 6 of us now, and we do anything, any social enterprise, any legal structure in the UK, anything to do with social inequality, and that's us.
Thank you very much. So I'm Jimmy Creek. I'm Director of Impact Finance Consulting. We are an advisory firm helping social enterprises and charities secure social investment. So the way we do this is primarily by what we call in those jargons, getting them ready for investment. So we prepare them the business plans and financial projections which meet the investor requirements. And so far we have completed more than 20 transactions, and our work doesn't just stop here. We also help you through the due diligence process, which is effectively when the investor asks you many questions about the documents you submitted, and we are with you until you hopefully get the money in the bank. So that's me, and my background is in investment banking. So I spent 15 years working in the city, so I know the way the social investor thinks and investor in general. So that's me in a nutshell.
And I'm going to microphones. Yeah, one's enough. So good afternoon, everybody. My name is David, and I work for a social purpose law firm. Do not adjust your set. Those words aren't often held in conjunction, but I work for a firm called Anthony Collins, and we are a legal practice based in the West Midlands and the Northwest, and we do work both with charities and social enterprises, but also with some of the social lenders who are in this room and who've been involved today. So we sit both sides of the fence, so we know what the social investors are looking for, but we also know what you and your organisations are looking for. And we get involved at the kind of technical stage. So when you've thrashed out the terms of a potential deal with your investor, then there comes a point when the lawyers get involved, and we will do things like work on the due diligence, which has already been mentioned today. I can talk a bit more about what that is and what that means. And then we get involved in contracts and loan agreements and grant agreements and lending documentation and all the paperwork that goes with that. And I'm here with my colleague Mike Nutman, who's right at the back. Mike, give us a wave. There we go, there's Mike. And we work together on, as I say, both for social investors and for third sector organisations. So hopefully we can bring a perspective. And as I say, we are a social purpose law firm. So our governing document says that we exist to improve lives, communities and society, and we are a B Corp, which means we've had to kind of pass a test to say that, yes, we're a commercial business, but we seek to actually help you achieve social purpose and social impact through what you do. So that's us.
Thank you, panel. And whilst you're all thinking about all the questions you want to ask, and remember it's hopefully going to be really practically focused, and for those of you online who are thinking about the questions you want to ask, please do so. We've got a couple of questions to warm the panel up, so they're just match ready for you all. So I guess the first question, well, I'm really intrigued by, and I'm sure many of you are, is what does a successful application look like? And if you are wanting to pitch it, to a social investor. Have you got any top tips? I like the way the microphone went all the way down there.
Should not have sat at this end of the line. I think the first thing I would say, and I think it's echoing something that they said on the last panel, is it's always appreciated when someone's demonstrated that they have done some research around the social investment market, because we may all be branded as investors, we may all be branded as having a social focus, but we all have differences. And so it's important, I think, to demonstrate that you've used, for example, the Good Finance website to look through the myriad of investors out there. Some have a particularly high risk appetite and a real impact focus. Some others are far less, have far lower risk appetite. So it's important to understand, you know, who you're speaking to when you go, and you'd be amazed how many don't. Last year we had about 200 applications into our inbox, of which we proceeded with conversations of less than 10, and that sounds like we're really risk averse and we have really strict criteria. The reality is half of them were not just investing the time to understand the sorts of things we were looking for. So I think that basic screen test is important, and then after that, for me, the three things that we always look for: impact is obviously the first conversation. If the organisation doesn't resonate with one of our impact criteria, and we're quite broad ranging, we look at societal issues, well-being issues, environmental issues. We do a lot in the care space and renewable energy space. But what's really important is that those values are met. But beyond that, it's not philanthropy that we're supporting. You know, it's not gift-based stuff. It is an investment. So we have to have a credible model, particularly for us when we're taking this out to members of the public to invest in. We kind of have a badge of responsibility to make sure they're investing in stuff that is reputable and creditable. So we have to try and forge that line between high impact and credible investment. And the third one is the people. It's so important. You know, we talk about investing in charities, but we're investing in people. We're investing in a board of trustees. We're investing in the leadership team. So it's really important that alongside impact, alongside financials, you are presenting yourself as someone who we can see will be good stewards of the money that you're going to receive, and will handle it responsibility, and therefore the risk that the investors won't get their money back is relatively low, and far more importantly, the impact that you will create is realistic and achievable. And I think realistic is a word I would use. Hockey stick projections are not helpful. I think it's really important that you have demonstrated that you understand, because we know the challenges that you're facing. We understand some of the public sector pressures. We understand the pressures that individuals are facing. So to come to us and not acknowledge that is not in your interest. So try and present something that is realistic as well. We get, you know, that passes the sniff test for us immediately. Those four things, I would say.
Thanks, Jeremy. And because I promised myself I was going to be brave today and ask about anything I didn't understand, can you just explain hockey stick projection, please?
Yeah, sorry. So you'd be...
I should know better, I used to play.
You'd be amazed at sometimes the expectations that investors really want to see growth in an organisation, and sometimes that's true, but if you present, you know, a scenario in which your social enterprise is going to grow from income of 50,000 to 7.2 million in the space of 2 years, it's not achievable. We know that. So actually what we'd rather see, particularly as most of the investment that we're raising is debt, which I'm sure is, understood, it's a repayable form of a loan. What we're really looking for is a charity or social enterprise that can demonstrate that they will continue to trade and generate income and a surplus on a relatively steady basis. So we don't need to see an explosive level of growth, which is what I mean by hockey stick. We want to see an organisation that's run in a financially responsible way, and therefore that the prospects of the investor getting their money back are high.
Thank you. Amy, did you have, or Jimmy?
Yeah, if you want, I think what I would like to add as I guess an independent advisor and working with the social investor on one side and the charities and social enterprises, I think one of the reasons why social investor receives so many requests in your inbox is because I think social enterprises and charities, not everyone are I would say, well aware of what the social investors want. I know Good Finance is doing a great job in terms of educating, but it is tough for them to navigate it. And that's why also you've got advisors like me, and you can find them on the Good Finance. But what I do with my clients, when just before we reach out to the social investor, we work on a request. And then, you know, the ask has to be sensible. And I think for an organization with, you know, with the founders, they haven't got any background in finance, you know, in banking, yeah, you might think you generate a £100,000 income and you could ask for £500,000 social investment. And if you do that and you submit it to a social investor, most of them will turn you down. And if you get a nice one, they might consider and say, well, I guess someone who's got a bit of time, and said, okay, to reconsider your request. But I think it's so important from the start to maybe understand, you know, what a social investor wants in terms of, as for example, as a rule of thumb, most of them will only invest roughly 1/3 of your income. So if you generate, let's say, £300,000 revenue, you probably need to ask for a maximum of 100,000, unless this is what they call a property project. Obviously, if you want to purchase a property, they can be more flexible, but the rule of thumb, it's 1/3. So I think, and in addition to what was said earlier, the social missions. Obviously, if social investors only invest in a homeless and you're doing something different, they won't be interested. So I think maybe what could be helpful sometimes is just maybe to talk to advisor or someone who's been through the process, and just to understand maybe the mindset of the social investor. And I know it's difficult because I experience this every day. It's the founders not necessarily have a background in finance. For me, it's easy, obviously, you have 15 years in the banking, but for someone we are not aware of this world, it's difficult. So that, just wanted to say that.
Great, thank you, Jimmy. So I guess the takeaway there is like anything, right? Like, do your research. So as you are setting up your community businesses and your enterprises, you will be doing loads of research, no doubt. So it's the same for any kind of funding, including sort of social investment. So thank you both for that. I was really interested, like, and every social investor that has spoken today has talked about impact, and I think you talked about being an impact first investor. You know, really interesting trying to balance this idea of social impact with kind of revenue models that will turn a profit, right? So Amy, I wonder whether I wonder whether you've got any advice on, you know, thinking about impact. I don't know how confident people feel about, like, reporting on their impact, or even thinking about their impact in a way that a social investor might recognise it. Can you shed any light on that?
Yeah, I mean, obviously social investors are going to look for impact, but everybody's at a different stage, and some impacts are easier to measure than others. So I think rather than worrying too much about what social investors are looking for in impact, worry about what is important to you and measure what's important for you in order to improve what you're doing and to understand your customer, because we're not your customer, and often we get that sort of, you can get sort of knocked off course a little bit when you start trying to meet the needs of funders and investors rather than focusing on who you're trying to serve. So, but I know that like, obviously we're investing in anything to do with UK social inequality. So, like, to your point about some investors may be focusing on a particular area like housing, but we'll look at mental health or employability, financial inclusion, anything. The thing is that all those different sectors are easier or harder to measure impact. Sometimes if you're working, say, with young people, measuring impacts that aren't going to be seen for sort of 20 years until they're an adult, that's really hard to measure and really costly to measure. So you need to sort of like get the right balance. I'd say when it comes to impact, measure what's important to you. And just to follow up on it as well, I think one of the things that you can because it's a two-way relationship, obviously. So you kind of want to work out if this is an investor that you want to work with, and sometimes seeing if you're aligned on what impact is and what's good. That's your sort of test. And I think sometimes, like, you know, somebody's really bothered about the impact if they're prepared to make the hard decisions to keep you going and to make sure that you're delivering impact, and they're prepared to sacrifice on the financial side. When the going gets tough, that's when you see which side it actually sits on.
And that's great, thank you. And that really crucial thing about sort of balancing kind of your business model and impact. So yeah, thank you for that. David, I promised no curveballs. However, I was having, and I'm really sorry, because I said to this person that I would give them credit for their brilliant question, and I've forgotten your name. If you're here, I don't know, let me know. But someone earlier asked about, it was really interesting, they were talking about social investors, and actually I'm sure you'll all agree, social investors are not scary at all, right? Like, they're really friendly, and the ones that you've got to meet today are great, and they're really interested in you. They're, you know, obviously I'm quite biased, but they do really care about, like, the work that you're doing, and they have a real interest in supporting you and making things easier for you. Now, when we were talking about this, he said that, so you get to know your social investor and your investment manager, and you've had this great journey, and then you come up against the legals, and they're quite hard-nosed, and you sort of go, hold on a second, we've gone from, like, something that's quite warm and friendly to something that's, like, sharp-suited.
Thank you.
You are sharp-suited, but also it feels like a bit of a culture shock, and I thought that was just really interesting. And I know, David, you had a conversation.
Yeah, and we see that, we also see it with local authorities around things like community asset transfer, when you might have a conversation with someone from your council about a building that they're looking to get rid of, and it's all kind of friendly and amiable, until you get to the point where you get sent a draft lease, and suddenly there's a document in front of you, and actually it's a really hard-nosed commercial document. And I think it's important that you understand the role of lawyers in this process, because a lawyer's job is to look after their clients' interests. That's always our role. So that means that the lawyers who are acting for the social investor are looking after their interests, not yours, and because that's their job. Their job is to make sure that the risks that their client wants to take are kind of built in, but there aren't additional risks that arise from the documentation. They want to make sure that if there are unexpected surprises, that those are taken care of in the documents. They want to make sure that their client's priorities are set out in the contract and the agreement. And that's why, and forgive me, this is a shameless plug, that's why it's really important that when you get to that point, you also take your own independent advice. I would say that, wouldn't I? But it is genuinely important, because we have seen time and time again that when community groups or social enterprises or charities are offered a deal, whether that's by a local authority or by a funder or by anybody else, actually you don't necessarily have to take all the terms of it lying down. And it's really important, first of all, that you understand what the documents say, so that you know, even if you can't change anything, you know what you're letting yourselves in for. So that's the first thing. But secondly, there may well be some scope around things like, you know, what the agreement says about payment cycles, around things like flexibility, around timings and so on. There may well be stuff you can push back on and say, well, actually, this isn't in our interests. We need to, you know, reach a slightly fairer conclusion here. And one of the things that we do frequently is negotiate those documents on behalf of charities and third sector organizations. So yes, it does all suddenly seem to get a bit chilly and a bit technical when it gets to the lawyer's stage, but that's when you need a friend in the room who can hold up your corner.
That's
if that's not a mixed metaphor. You can hold up a corner? I don't know if you can.
I don't know, I mean, maybe.
Okay.
Yeah. Certainly in your corner, I think that's the thing. So, no, great advice there in terms of sort of getting your own advice, right? Like, think about the friend in your corner. And I think Reach Fund can contribute to some of that if you do need that advice. So, you know, talk to your social investment partners about accessing some additional grant funding if you do need that support.
Can I do a follow-up?
Of course you can.
Just to say that there are, from a legal perspective also, there are some things that you can do kind of before you get into the investment conversation that will help. And the first is just to make sure that your own legal structure and your governance is kind of tidy and fit for purpose. We do sometimes come across clients who kind of don't understand that their own particular legal structure means that they can't have a certain type of investment. So if, for example, you are a KIC and you are limited by guarantee, you can't get share investment. You can't have equity because you don't have shares. Guarantee companies don't. There's no such thing. So there's some basic stuff that you can do before you get in the room with an investor to make sure that your own house is in order. And that kind of thing always really, really helps.
Oh, that's great, thank you. And because we're doing shameless plugs, I think just to remind us that Good Finance, I think, has some really helpful tools, just some basic stuff on legal structures, which is great as a starting point. So I am sure that you're all warmed up and got some really great questions, and we're going to check some of the online questions as well. And one thing that I would say to you is if you are thinking of asking a question, but you're feeling a bit fearful, you're not sure if how it will land, don't worry, because I bet you there's someone else in the audience. I bet you I will be really grateful that you've asked that question, because some of this is like complicated, some of it's complex, some of it we're just really curious about. So be brave and ask the question is what I would say to you. But before we do go to your questions, the last question for the panel at this point is really what happens when things go wrong?
I'll start. That's our kind of stock in trade. So what the first thing is, you hope it doesn't get to us. Because I think what was said this morning is that actually communication is the first thing that should happen when things start going wrong. So for goodness sake, we would always say, talk to your social investor, have a conversation, get involved. Because if it gets to the point of formal stuff happening under the kind of agreements that we negotiate, that's already one step down the line. And you don't want things to go badly wrong, because the documentation is drafted so that, for example, if your lender has security over your building and you go bust or you can't pay, then they can come and take your building away from you. And we want to make sure that doesn't happen. So engage early and have sensible conversations, with my comment on that.
When things go wrong, I'll go back to 2020 and everything seems to go wrong. No, I think you sort of preempt what happens. I ask that question at the beginning when you're talking to somebody, and I usually suggest, if you're looking at social investment, talk to other organisations that they've invested in, because then you'll get a sense of, and ask them that question, how do they behave when things aren't working out? But generally, I kind of feel like it is back to communication and relationship. I want to have a relationship, and I would hope that you would want to have a relationship where when things are going wrong, that we're talking about it, because we want to be able to help when things are going wrong. I don't want to find out that everything's gone wrong and have somebody calling up in tears because they can't meet their side of things. We're always going to be flexible, but we want to be able to help early on, not when everything's gone. I was going to swear then, I won't say that, but insert swear word there.
So we've got quite an unusual role, given the way that we raise capital. So we will work with a charity to raise funding from our investment crowdfunding audience, as I said. So theoretically, when we've helped the charity to do that, we step away. So on an operational level, ongoing, if something went wrong during the lifetime of that borrowing, theoretically, Triodos on our team don't have sort of a contractual responsibility. But I think what we do have is an absolute recognition. We have a reputational exposure because we've supported that charity, sometimes very prominent national charities, to raise funding. So to play that card would not be the thing that we would do. And I think it's absolutely the case, isn't it, that communication is critical. We would much rather have a dialogue 9 months ahead of time to say, we can foresee a problem, or if you're not in that position of luxury where you can foresee it, as soon as it happens, talk to us. And I think you'd be amazed how receptive the investor or the intermediary is in that situation. Only last week, and it's not in the charity space, but we had a client who was very reliant on specific receipt of funding to enable interest payments to their social investor. And that provider of funding just said, the provider of income, in that case it was a slightly different sector, said we're going to be late in paying you, which meant theoretically that organisation couldn't pay their interest on time. But because they came to us, we were able to structure it so the interest payment date changed, so there was no problem. But had they, in theory, left it, it becomes a problem. So there's ways of mitigating it through good communication.
Although I'm not a social investor, and I'm probably on the good side of it, because I help social enterprises and charities secure social investments. So when my works stop, usually everyone is very happy, the social investors and the borrowers. But what maybe I would like to add here is based on my previous experience working in banking, and to just highlight the difference between the social investors and the high street banks. I think from my experience, social investor will always work with you, and they're not going, if you cannot repay, they're not just going to go and enforce your guarantees, securities like your high street banks. So I think that's just a clear distinctions. And there is, I heard, I think earlier, I think some organization was saying they were struggling to get a loan from the high street banks. I think just from experience, high street banks do not like lending to charities and social enterprises unless you're a large one. The reason being is if things goes wrong, they don't want to have to make the headlines of any newspaper saying, oh, Barclays went after this charity is doing good. It doesn't. That's why. So what they tend to do, they just don't want. They just don't want to lend, so they don't end up in this situation. Apart, obviously, if you have, you are a multi-million charities, that's a different story.
Great, thank you all. Hopefully that feels pretty reassuring for any of you who worry about what happens when things go wrong. And now it is over to you. Hopefully you've had lots of time to think about questions that have been, brewing, bubbling over the day, or actually any interesting reflections that you've got. And if you want our panel to ask, you've got any questions to ask our panel, yeah, great.
Hi there, my name is Saida Ashraf. I'm the founder of She Wise Charity. We work with South Asian women in the space of violence against women and girls. We also do their well-being and skills development. I just wanted to know a little bit, you touched on about interest rates and commercial banks and how they're different, and as I understand that you are more sort of receptive to charities, but there are banks who are also interested as well. So what's the prime difference? Why would we come to you and not them? I hope that makes a difference. I mean, I assume it's more in terms of the rates that we pay back, the payment rates. Is that the key reason? Or?
Well, it's a great question, and I think I'm going to hand it over to the investment partners. But I mean, it's an interesting challenge for us, and I don't know of my colleagues that want to sort of take it first.
Yeah, maybe I can start. Just I think in terms of the main difference, I know that obviously some banks will lend to you, but the bank, I don't think there is any banks, high street banks, will lend to you without director guarantees. And if you happen to have a house, they will take also, as you give your guarantees, so basically your house is also on the line. So the social investor I work with, so far I haven't seen, they don't ask for director guarantees. And then obviously most of the loans are unsecured, so obviously the larger amounts and the property will be security over the assets. So I would say that the main difference,
I'll do it and then keep passing it down. I guess social investment can be so many different things. So it could be a loan with a fixed interest rate, but it could also be equity, or it could be something a bit more flexible. And I guess, like, if I was you, and if I can get a loan from a bank at a decent interest rate that's affordable, I'd probably go for that rather than going for social investment, because if you can afford that interest rate and it's with a known bank, you know, it's a sort of standard product, then that's great. A lot of social enterprises, though, that's not suitable for them, either because the interest isn't affordable or because they need more flexibility on when they're repaying. So they're looking, and they might want something longer term. So often, like, bank loans are sort of a short fixed term, fixed interest rate, whereas social investment could be for like 10 years. And much more flexible in terms of when you're repaying. The other thing about social investment that I think doesn't sort of get included with when you're just sort of comparing interest rates, as an example, is social investors are normally looking to provide a bit more than money. So they're often providing networks or skill support or just even encouragement, whereas it's a much more arm's length relationship with a high street bank. And yet often, when we're talking with social enterprises, they have looked at their banks, but the banks can only offer a certain amount for a certain period of time, and they want so much from the directors of the company that it feels a bit too risky. So that's often where we're coming in. So I think those are the differences, but there's not a right or wrong on anything. It's what's the right thing for you, really.
Yeah, I think that's it. I think for me, there's two or three fundamental differences, some of which have been touched upon. One is that there are areas where high street lenders aren't prepared to go just because of the risk appetite, and social lenders, whose very remit is to support organisations that create impact, are exactly placed to do that. I think the second one is sometimes around scale. Sometimes the areas in which we are supporting, the size of the lending, the size of the sector might be too small for some of the high street banks like HSBC to warrant an investment in supporting. But I think the third one is that fundamentally your social lender, your social investor, should in theory have expertise in this area, in this arena, which isn't necessarily the case. You know, the way Triodos Bank structures its lending team is no longer around geography, it's around sectors. So it has a well-being team, it has a societal team, it has a circular economy team, it has an energy transition team. So when you're building a relationship with that individual from that team, they should in theory really understand the challenges that a care business is facing, the concerns that housing association RP is facing. And that might sound not that important, but it is really important when things go wrong. Because when you broker a conversation, they understand it in theory, and they can work with you to come up with a solution, as opposed to let's go to doomsday scenario. And I think the other fundamental thing I sense certainly at Triodos is we talk around this idea of security. So if you lend to a charity, does it have bricks and mortar that lender can take a charge across? But the reality is, I know certainly for Triodos, that is really the last resort. That's not somewhere they ever want to go. So yes, they do lend on a secured basis, but first and foremost, they want to understand that it's something that you as a charity can comfortably service without exposing the trustees and the leadership group to too much exposure. Whereas if you've got a bank that's is comfortable that their loan is secured, the rest might be secondary because they know they're protected in the long run. Whereas what we want is a solution that can get you out of before you get anywhere near that.
Just going to add on the interest rate, because you actually asked for this, and obviously, in my role, I see quite a lot of products across all the social investors. What I would say in terms of insecures, you have to also differ. There is a difference between foundations. So some of the foundations, social investors, they will be able to lend at below market rate, so even below the Bank of England interest rate. So you can get interest rate as low as 3%, 4% for some foundation. After maybe, because obviously I think they're not there. And then obviously it depends whether it's secured or unsecured, but on unsecured, I think what I've seen, it's probably you are maximum 9%. But one thing I'd like to add when you compare with high street banks it's now they've been quite a lot of blended finance. So what they call blended finance is a social investor will offer you a mix of a loan and a grant. So let's say if you wanted 100,000, you could get up to 80,000 pounds as a loan and 20,000 pounds as a grant. And this is something you won't get with the high street banks.
Thank you. Nice little plug there for blended finance, which we're really really passionate about. We've got a couple of questions online, and then we'll come back to the audience. Sorry, did you? So, and again for you, David, a couple of questions about the legal support. So the first question is, I think I know your answer to this, but it'll be interesting to hear. Do social enterprises require legal support during the investment process?
Yes.
We didn't say
At the right moment, and I would say, and this is a plea, is if you can, talk to lawyers early. That's incredibly helpful, because if you come to us very late in the process, then inevitably we're going to have some questions about the deal, and if everything at that point is you've kind of thrashed everything out with your investor already, what we don't want to do is to make you try and go back over old ground. But we will have questions, and actually some of those questions, the answer to those questions might affect the deal that you go into. So at least early on in the process, talk to us in broad terms about the kind of deal you're planning to do, so that we can say, yep, that's fine, that all sounds from our perspective like it works. Or if there are issues we need to raise, we can raise them then, so they're not a surprise later in the process.
Brilliant, thank you. I know you've got a question. So there's just the second one to this, which we've sort of talked about a little bit, but I don't know if people on the panel have a favourite sort of resource that they go to when looking at legal structures.
Well, again, there's another plug. On the Good Finance website, you will find, I can't remember how you find them, but there are an excellent selection of videos on legal structures featuring a colleague of mine and indeed me, talking about different types of legal structure and when you might use them and their kind of key characteristics. So that's a very fine place to start.
Do anyone else have a... I mean, if they're videos starring you, please feel free to plug them. But yeah, no, good place to start, the Good Finance website. And sorry, you had a question, didn't you?
Hello everyone, my name is Farah. I run a social enterprise called UPress that works with young creatives, and we open doors for commissioning opportunities. Never secured a social investment funding. I've got a question for you. If you've never applied for social investment, there's that fear when you're having that conversation, and that fear can sometimes come off as desperation, but really is saying, I need help. What tips would you give to speak the language so it comes out more confident, especially if you're starting out, because it's quite scary, to be honest with you.
Can I start with that? Forgive me. And I say this as someone who kind of sits a bit outside the process because we advise on it and we see people going through it. I guess my observation would be, do not be afraid to be yourself. You know, if that's how you feel, that's how you feel. And that's entirely understandable. And the social investors who you are talking to will understand that that's how an enterprise in your position might feel and might react. There's a whole load of kind of practical preparation work that you can do before you talk to an investor in terms of your business plan, getting that stuff ready, knowing what your business model looks like, making sure you've got your ducks in a row around that. But we're all human beings, and any social investor worth their salt will understand that, and the good ones do, in my experience.
I always feel really nervous as well, actually. So you come and talk to me and we'll both be nervous together. But I think it's kind of like, it's exactly like, I think you should be able to say to a potential investor, actually I feel really nervous, because it should be the investor's job to put you at ease. And I'm trying to do it myself. I actually call myself out when I start using jargon, because I think like when somebody uses jargon, you're trying to make it mysterious in some way, and it's actually just money. It's not anything super complex. We make it sound complex. So I think but that's also like a nice test for you. Like if somebody can make you feel comfortable talking about what they're doing and asking questions and going over things again and put you at ease, then you can probably sort of feel like, well, this is somebody I could have a relationship with. And it's the same any sort of relationship or any business relationship that you have. If somebody's making you feel like this is scary and nerve-wracking, then it might not be somebody you want to work with anyway. But yeah, just being yourself really, I think is fair enough.
There's not a lot else to add. I think the word human is absolutely right. We're human beings. I mean, I'm not going to pretend there's areas of my life where I don't have fear or feel like an imposter. So why would it be any different? So, you know, I think authenticity is absolutely the key word. And I think when you come to us, we get a lot of stuff that we have to say no to, which are stuff which is unbelievably impactful. And I love on a personal level what we can't do within the remit of what we're designed to do. But I like to think on all of those, I'll be able to say, this is amazing, this is great, it's not for us, here's why, and signpost and send you to an organisation that might be able to help. So I think hopefully out of that, regardless, once you've overcome that uncomfortability barrier, you've had a conversation that was helpful, even if it wasn't an immediate yes. Be human, be authentic.
Yeah, love that. Be human, be authentic. Does that assuage your nerves a little bit? And also, I've got a question, because did anyone feel, oh, you don't have to put your hands up, but just a bit of reflection. Did anyone feel a bit nervous coming today? I did. I was really nervous. And it's people feeling less nervous now. Yeah, I can just tell there's like a relaxed vibe in the room, which is really lovely. Not hopefully too relaxed, because we've got time for a couple more questions. Great.
Hi, I'm Alice from Sutton Community Farm. I was wondering if you've got any advice about whether to like keep multiple investors in your pipeline or whether to focus on the one that you think is the best bet, and yeah, kind of balancing that tension.
Yeah, love that question.
I guess it's more an advisor question. I would say you could do that, but you would spend a lot of time. So I would think probably my advice is it's probably one or two. I think it's normally what will happen is, I mean, the way I advise my client is from your research, you should go from what's the best match first in terms of what they're offering, the products, the rate, and so on, and the social mission. And then you should go for this one. And then obviously, if for some reason it's not available, then you can look at another one. But I would say and I would say probably one consideration is the timing. Obviously, if you're desperate for the funding and you need it in 3 months, yeah, you might as well just go, you know, for 2 or 3, because then you need to manage as well. Because yeah, there is an application, but then you still need to have the capacity to manage the due diligence, all the questions, the back and forth. So, yeah, and you could also, if it's a capacity issues, you have also access from the foundation. You have the Rich Fund, which was mentioned, so it gives you access to advisors, and there is a grant to pay for this, and the advisor could help you to save you time, because he should be aware of what's good, what are the products in the market and the most suitable for your organizations.
Great. And at the risk of making this sound like a dating app, I mean, from a social investment partner point of view, like, do you have people that come and maybe are talking to multiple social investors, or generally when they approach you, have they, you know, they've done their research, they know what you're about, maybe they've done an eligibility check. Do you ever get that?
We tend to be working with organisations that haven't had social investment or any investment before, so we tend to be a first conversation. But I kind of like the idea that, well, I like two ideas. One is, wouldn't it be great if you actually did have a whole load of investors who could be suitable for you and they're competing for you, rather than you sort of feel like I've got to keep putting your best face on and all the rest of it, full makeup. But the other thing, and I know somebody is working on this. I just think it'd be great for the sector. Is, you know, like when you're trying to get your car insurance and you go on comparethemarket.com or something like that. Wouldn't it be great though if you could just like put in your thing in your words and then have people sort of come back and sort of, yeah, somebody to do that. Anyway, there you go. Good finance could sort that out.
What to add to that? I think there is value in an advisory role sometimes, because it might look complicated. You might know not which investor to approach, and there are some projects that we've supported charities with that are quite complicated. Nearly all of them have a jigsaw of funding: some grant, some conventional senior lending debt, some debt that's unsecured in the middle. Pulling that all together is quite complicated and knowing where to start. So there is value sometimes in getting a helping hand. Ideally, if it's funded by Reach, brilliant, to pull all of that together. I think there's also projects but where we have had examples of lenders co-lending alongside each other. We've had stuff where CAF has invested alongside Big Issue, for example, or where my lending colleagues on the Triodos team have lended alongside the stuff that we've raised through our crowdfunding platform. So it's really common to do that. I would say, go back to that research piece. Some lenders might not be receptive to that. They want the whole piece of the pie. Hopefully not, but sometimes. And also resource. Do not go through that journey to find you invested a lot of time trying to spin multiple plates, keeping multiple investors happy, to end up with potentially nothing. So yeah, that's the role I guess you're playing. The role sometimes that we play was just to stand back and say, who's the best fit here for you? We know what their lending limit is. We know how much you need, so we're going to have to try and do something imaginative here to pull various sources together. Trying to do that whilst trying to run a charity, whilst trying to do other things, is quite hard.
Yeah, just one thing to add quickly on that, if I may. If you have got more than one social investor involved, it's just worth you knowing that they have different expectations about where they sit in that kind of pecking order. So some investors will say, well, we have to be at the top. So we have to be the first priority lender, which means that if anything does go wrong, we take first, as it were, and other people have to accept being further down the pecking order. Sometimes that's fine, and you can work it out, but obviously you need to know how the different social investors feel about that and their attitude to it, to make sure that's going to work, which is part of that complexity that Jeremy was talking about.
Brilliant. Some helpful, practical advice there. Great. Okay, got a question for the lady in the green dress, Diane.
Hi, my name's Diane Williams from Motas Community Trust in Coventry. First, just an observation. We've worked with David over many years, and I would say that the advice and the relationship has been very important to us. We've got into some very complex issues which haven't been social investment, but we've needed good legal advice that we trust. And so, just a thank you. Yeah. But first of all, a bit of an observation. The diversity, knowledge, energy, passion and commitment in this room is palpable. And I think it's a very rare thing to see that and to have so many people together. But one of the problems with any sort of investment is you've got to raise your profile, and we're all too busy to do that. And the breadth and impact of the whole sector is largely misunderstood and or distrusted by the private sector, the banks and the public sector. And so when we do come to investment, that is a problem because we're not understood. So I was just wondering if there was an opportunity here with us in the room and the investors to actually raise some positive profile of the sector and our impact and how actually we are making a real difference to society. And I just think we've got to do that collectively, because the trouble is we're trying to all do it on a one-to-one basis, and it doesn't add up to a good enough picture.
Yeah, no, great question, Diane, and I think this is about this kind of collective way of demonstrating our value as a sector. You know, some of us will have heard the word ecosystem mentioned quite a lot, and I think that is a really great way of describing the sort of social investment, charities and social enterprises sector, because, you know, we need to coexist. We need you. you know, we need both sides. We need all the mycelium network, for those of you who are that way inclined, to be nutrient rich. So we've got to do the work with you guys and do the pipeline development and support you in terms of your business models and trading. And I'm sure Diane won't mind me mentioning, but, you know, do the kind of pushing those who are in your, you know, to support your business models to work and to get out of the way of you doing your brilliant work. And I don't know if people have a view on this kind of how we raise a profile collectively. Mal, you might have some thoughts on it, but I don't know if the panel at this stage.
I mean, forgive me one observation. I mean, absolutely. I guess sitting where I do, and my kind of job title at AC is that I'm head of what we call social business, which is basically anybody who is seeking to make a difference through enterprise. So right through to commercial organisations who want to become employee-owned and reflect their values and how they work, right through to kind of the grassroots community sector and everything in between. And my sense is that that way of doing business, and well, my hope anyway, is that that way of doing business is slowly but surely gathering some traction. You know, when we used to come to these sorts of things 20 years ago, you might have half a dozen investors in the room. Now you've got kind of nearly 50 on the Good Finance kind of website as people who actively want to lend into this space. And it's still, in the overall scheme of things, in terms of lending, it's still a bit kind of niche, what we do, but it's less niche than it was. And in all sorts of other ways, you can see there is a gradual interest in, for goodness sake, how do we do business better? And all of you in this room, if you're thinking about having social investment, need to think of yourselves as doing business, which is simply doing something that trades to generate a surplus, because that's how you repay finance, right? But actually, you know, that's all about how we do business differently and better. Because I think we all, you know, you look around and you think, well, it can't carry on how it used to be, because it's just not working for anybody. But I am hopeful.
Anyone on the panel? No. But we're working on it. How's that? Sorry, a question. Does someone have a question over there?
Thank you. I'm Georgina Wilson, founder of Bud Leaders. We support social enterprises to access finance and also supply chains and routes to market. I have a question that follows on really about the kind of the confidence side of things. Because I think it feels to me that there's a little bit of a gap between, I guess, pre-investment processes and actually how you kind of get from the stage of starting a business and then wondering how you're going to grow and actually having the confidence to believe that you can even be in a position to approach an investor. And then also what happens when you get lots of doors closed. So my question really is what would you advise organisations that maybe don't feel confident enough to be able to approach you in the first place, and then, you know, to be able to have the resilience to, you know, face lots of closed doors? And I'll just add that we did secure our own investment, but actually we were approached. And I don't know if I would have had the kind of confidence at that point to go out to market and seek investment. So yeah, what would you say in terms of confidence and resilience?
I'll have a crack at it first. No, I think I see like that there's a huge untapped market for social investors because there's so many social entrepreneurs, you know, how you describe actually, why would you, I mean, to be honest, if I was setting up my own business, I think the last thing I'd be thinking about would be investment, because what you're thinking about is I need to win work and I've got to get customers and I've got to find my routes to market and those sorts of things. So it is like you're almost a step away from even thinking about having the confidence of talking to an investor, is even thinking about investment anyway. So I think there is a need, but I don't think that's on the another burden to put on social entrepreneurs, that as well as, you know, delivering impact and building a business and managing a team and all those sorts of things, you've also got to fix this problem that people don't know about it. It's more that investors need to be doing that outreach. I would like to see more proactive work on the side of social investors, you know, and I take that on for me as well, of actually going out to communities and going out to people who historically wouldn't have, because otherwise I'm just sitting here waiting for people to come to me, and it's going to be the same old. Not, it's all really great. It's just that you're not tapping into the whole market. So I think there does need to be more outreach type work. That's more essentially us knowing our customer and trying to serve our customer better. And I'd like to see more confidence building, because I do think that you know, sometimes culturally, if you hear people talk about loans and debt, it just sounds like, when I hear loan, I think loan shark. And I was brought up, like, my dad always said, don't even take out a credit card. I do have a credit card now, but I haven't told him, because he wouldn't ever have, you wouldn't do that. You wouldn't have, don't owe anybody money, don't gamble, none of that sort of stuff. And so all this stuff sounds culturally super risky. So there is an element of also understanding that as well, that sometimes people coming from a background where this seems even more scary than you're expecting. So, but that's the job of social investors, is to make that more understandable and seem more accessible.
I'd say 3 things. I'd say that a lot of the challenges that you may have experienced as a sort of fledgling young charity is probably very similar to lots of people in this room. So when you feel like, oh, I'm not that imposter syndrome, I shouldn't be speaking to social investors yet, if you turn back inwards towards other people in the sector, just sharing that and bouncing it back off each other, there'd be plenty of learning, plenty of experience, even if it's just an emotional outpouring. Gosh, this is tough. What did you do? There's a really good starting point. And I think linked to that is, you know, this idea of mentorship in any walk of life, leaning on, drawing on people who have been there and failed, been there and succeeded, is a really great learning opportunity. And I think the third one is social investors are under pressure too, right? Like, most of them sit on funds where they have an obligation to deploy it, get it out the door within a period of time. So you think you're going to them and they're sat there going, nope. But the reality is, if they are failing in their objectives, is they cannot get that money out to you to create impact. So there is a willingness there. It's just about finding that connection.
That's great. We are at time, I'm afraid. So if anyone does have questions, like, I think a few of us are going to be sticking around after this, come and find us, or come and find the good folk from Good Finance. But I just wanted to say a massive thank you to the panel for offering like brilliant and really practical advice, but also thank you to you. It's been a long day, it's really warm, and for sticking with us after lunch and being so engaged and thoughtful questions. So a massive round of applause to you all as well.